In this video, you'll be learning about this topic. So there's a term you used in your book that I just really liked, and I like the way that you went about this. And the term is disciplinary constraint. And when we think about this, what you really get into with this term is fractional reserve banking. Can you give us a background on fractional reserve banking? Because this is what got us to this point. And I think when I talk to a lot of people, they look at what's happening around the world right now and they immediately want to blame the politician that's currently in office or the one that was in office the term before. And I think it's just so narrow-sighted as to what's really driving what we're seeing today. And I suspect that it happened decades ago that got us into this place. I think you agree with me because we chatted a little bit before we started here. So can you talk to us about this term, disciplinary constraint, and then particularly talk about how it played out from the 1940s into the 1970s and 80s here in the whole world, not just in the US, but globally?
So disciplinary constraint is another term that comes from the inherent hierarchy of money paper. And what Professor Merling talks about is that disciplinary constraint is how much you have reserved against how much you're issuing in terms of money. So if a bank has $1 million worth of gold in the vault and issues $10 million worth of deposit money, that's a 10-to-1 or a 10% fractional reserve situation.
People can understand this in Tether terms because it's such a hot topic right now. If Tether had $10 in their treasury, but they've issued $100 worth of Tether tokens, that would be the exact same scenario that you just described, correct?
That's right. So we see that when the fractional reserve banking evolved, that gold it exercised discipline on how much money a bank could create. Because in the end, if there's a bank run, they have to be able to satisfy enough people's deposits or demand for redemption that enough confidence could exist for that entity. Now, I do believe that fractional reserve banking is a natural evolution because people want credit and people treat credit as money. That's the way that I, saw when I was researching that's kind of how it unfolded.
Well, and you also laid it out in your book, Nik, that once the governments inserted themselves into that second and first layer, that this was a natural progression because it's a form of taxation. And if they can just print more in order to supply whatever that base quote unquote money is, it's so much easier for them to do these types of things. But whenever it was all localized, and you provide this in your book as well, when gold coins were privately minted and distributed, and we're going way back in history, you didn't necessarily see these activities because it was all about you saw it in some regards, but then in others you didn't. They lasted for decades where particular mints were trusted because they had 100% backing on whatever paper they were issuing on its behalf.
Yeah, and in the book I talk about this idea of privileged lending. When the government inserted themselves between the first and second layer of money, they lent money to themselves in a privileged manner and benefited from that money they lent to themselves being on par with all the other gold-backed money that was out there circulating. And that's the taxation that you're talking about, because what you're doing is you're altering the denomination by inserting your own privilege into it. And that was a precedent that was set with the Bank of Amsterdam and the Dutch East India Trading Company and the city of Amsterdam itself. The city and the company inserted themselves into this privileged situation where the money that they issued to themselves was on par with gold-backed money of the people of the Netherlands at the time. And that precedent led to the Bank of England doing the same thing when they wanted to finance a war at the end of the 1600s. And that is how, when the Fed owns US Treasuries, that's what's happening as well. It's a form of privileged lending that originated from the Bank of Amsterdam.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.